So Lori, perhaps we start there and why small caps should be taking on a little bit more focus right now.
So I think one of the pushbacks you see against large cap growth in particular is just the valuations, right? I think that people feel like we've been through something, whether or not we're going to have a recession, is an ongoing debate. But people don't want to pay up for expensive stocks right now. That's been pretty clear in my client conversations. So you have clear valuation appeal on small cap. And that's one of the chart I have on small versus large going back 30 years, showing we're at the most discounted levels that we've seen since the tech bubble, kind of the lows of the past 5 or 6 years. That's the top chart people ask me for on small cap right now. And it's coming up as people are preparing their second half outlooks or starting to think about their client marketing. And then when you sort of go and have a deeper conversation, you have to kind of pick things away a little bit. So earnings have been fantastic on the large cap part of the market, but small caps are starting to look less bad, I guess is how I would put it. You're seeing large cap kind of lose its dominance as the only game in town where you're seeing upward revision. So small caps are looking a little bit better by comparison. The other thing we're seeing is money flows are starting to shift out of large cap growth funds and back into small cap funds of all flavors, most notably on value and blends. So you can see actual retail investors starting to move that money around and chasing the valuation opportunities. And I think the other thing that comes up a lot is balance sheets. So people are still trying to make sense of what we do, with these huge Fed increases that we've seen, and companies aren't really feeling the brunt of the impact yet. And so we've had a lot of conversations on small caps, like when is the shoe going to drop here? And we point out things like, if you look at the weighted average debt maturities of companies, only 9% of Russell 2000 companies have a weighted average maturity of less than 2 years. Most of it's sitting in that 2 to 5 year window. So if the Fed starts cutting next year, that's going to help solve that problem. Now, there may still be some headwinds down the road, but there's time to fix it. The other thing we tell people on small cap is, just like the large caps, the management teams are pretty savvy. They loaded up on long-term debt at low interest rates back before the Fed was hiking, and they're benefiting from that now. The effective interest rate of the Russell 2000 right now is only about 4.1%. That blows people's minds when you tell them that.
What is it for the S&P 500?
There are 3 different ways we calculate it. I say we come up with one version that's 1.7%, and the highest version, which is just a simple median, is about 3.1%. Okay. So there is a gap, right? But that 3 and that 4.1 I mentioned on the Russell 2000, that's also a median. So there's a gap, but it's not as big of a gap as you might expect.
Okay, gotcha. So they're still paying more, but not as much more as you might expect.
Right.
Something else that feeds into sort of conventional wisdom about small caps is the dollar, right? And there is this way of thinking that, the Russell 2000 is less international than the S&P 500. I guess, A, I would ask, is that as true as people think? And B, how does the dollar story play into small caps this year?
So it's always hard to figure exactly what the earnings representation is. It's a little easier to figure out the revenue composition. And the revenue composition of Russell 2000 is about 19% international. And that's been a pretty stable stat over the years. We used to have to handpick that out of filings. Now we can download it through data sources. But it's been pretty stable in kind of that 18, 19, 20% type range. With the S&P, different people come up with different numbers. I've always come up with like 33 to 35% based on how we calculate the numbers. So if you are seeing problems in China, right, if you're seeing rising recession risks in Europe, that is going to hit your big cap part of the market more acutely. If we have a more resilient economy in the U.S., that is going to benefit your small caps much more.
Is there an overwhelming kind of theme or even a sector that is leading small caps right now, and that you're seeing kind of the most effectiveness for investors to kind of glean their eye towards a little bit?
So, it's interesting. You're definitely seeing some better trends, on some of the more value-oriented sectors. We're having some problems on kind of growth across the board. There's kind of a leadership shift that's attempting to happen that can't really fully get going. But in general, we tell people you don't have to get too picky on the sectors with small cap. Almost every sector in small cap is cheap versus its large cap counterpart. The exceptions to that are utilities and staples, which are 2 very tiny sectors in the Russell 2000. But you can, if you don't want to deal with financials, you've got plenty of valuation opportunity in things like consumer discretionary, energy. Industrials is another one that's not on a lot of people's radars.
And go ahead.
No. I was actually just going to think about when we compare kind of these small caps earnings calls, because as we were mentioning a moment ago, you guys talk about and you digest a lot of earnings data as well.
Yeah.
Small caps earnings calls versus what you're hearing in the tenor versus some of the large cap earnings. Is the vibe similar? Is the tone vastly different? What do you?
So I will tell you the AI tools are not good enough yet to let us get through the Russell 2000 earnings calls, and we're keeping it sort of concentrated on the S&P. The stats, it's still a little too early to tell because while we're all breathing a sigh of relief that S&P 500 earnings season is mostly done, I mean, last week was insane, over 150 companies. Russell 2000 numbers come in later. So the small cap portfolio managers are still very, very busy right now. You should be extra nice to them if you run into one.
We will do that. And again, just pivoting back around to the conference calls, because again, I am sort of fascinated by your analysis and the AI-assisted analysis of that stuff. So besides AI itself, what are some of the other themes that you were hearing more about on these conference calls, either that were new or that just keep coming back again and again?
It's a weird spot because I feel like the old narratives are dwindling. I mean, we even track this quantitatively, references to pricing, inflation, recession, uncertainty. Those are all dropping, pretty steadily. We have one that we look at headwind references versus tailwind references, and the headwinds are dropping, but the tailwinds aren't really picking up yet. And I think that's a perfect analogy because I feel like the old conversations are fading away, and other than maybe AI and inventory destocking, it's not necessarily clear to me exactly what's picking up. China, we looked at, that has moved up a bit in conversation, but it's nowhere near what we saw in the trade war period. Weather, we notice coming up a good bit, but it's just kind of a cyclical thing, and it's not really, it's kind of similar to where it's, moved up in the past. So we're not seeing anything that's alarming there. But I think the inventory destocking and AI are the two big ones. I will tell you, Julie, I have been annoyed in this reporting season because I always go through and try to, figure out what these new themes are. And I also really look at the outlook commentary. And the outlook commentary is really lacking right now. There's just, I describe it, there's just no meat on the bones right now.
So does that set up for just another type of relief move that we may see in the next earnings period if you have companies that are largely just compressing what that outlook may look like in order to just safeguard against missing?
It could. I mean, what I think we're seeing is kind of more short-termism coming back in. Sell-side estimates are usually right-sized by the middle of any given year. Most years we see earnings forecasts start out too high and come down, and by the middle of the year they're kind of right-sized, which tells you that companies are really just kind of managing very closely to meet the 3Q and the 4Q type numbers. So I feel like that's probably what we're going into. You tend to see at the end of a calendar year, companies don't want to have the outlook discussion, and they'll say, we'll come back to you in January. We'll come back to you in February. That's definitely what we saw last year. And there may just, we may just see a repetition of that same pattern. We talked about a pause in our macroscope, and it's not so much that I see huge negative catalysts from earnings coming. It's more that we had this nice positive catalyst. We had mostly upward revisions in 2Q. If you looked at it at the company level, it feels like it's played out. It feels like we're going to be in sort of no man's land, kind of in purgatory a little bit from an earnings perspective.
It feels like we're sort of water treading at the moment in a way. So when we look ahead at potential negative catalysts, we had an interesting discussion last week with Mohamed El-Arian in the wake of the debt downgrade of the United States. And he also talked about what he's been saying for a while now, which is he still thinks the Fed is the biggest risk to U.S. equity markets. Not necessarily that they're going to keep raising, although they may, but also that what they've done already is potentially too much in terms of the retroactive damage it could do. I'm just curious how you're thinking about that.
So the street, I think, has made peace with the idea that the Fed moved very quickly. Most investors I talk to do want inflation dealt with. They don't want to go through with this again. So if we have to take another hike, I feel like most equity folks at least would be okay with that. I'm not sure about the hedge fund crowd and the fixed income crowd, but I think in equity land, they'd be okay. But I do think we've got cuts really firmly baked in for the second half of 2024. So I think that's going to be a part of everybody's 2024 year ahead outlook thesis. And if you start to see the Fed push back against that, then that could be a problem early next year.
I was just looking up to see if the macroscope as a podcast name is taken, so excuse me for a hot second.
Was it taken?
It is taken, but perhaps
I have a podcast, though. It's called RBC's Markets in Motion.
There you go.
Markets in Motion. I like that.
Yeah.